Hey, what's going on? It's Tuesday, 10 a.m. Eastern. We're doing live financial modeling here, used car lot, dealership, uh, model. So yesterday we did a we haven't even gotten into the three statement modeling because we upgraded or started upgrading the purchase schedule and rearranged all this so used car lot, you need to plan out, how much car inventory are you buying? When are you buying? When you're starting to buy this inventory based on, we've got 10 different car types or vehicle types, and how long do those vehicles last on your lot until they sell? And then we got this matrix to find that for each different car type. And then you've got how many you're buying per month. So this required new logic. I just had to rebuild it all. So we started doing this yesterday on this matrix tab. And it's important for the three statement modeling and the inventory and balance sheet and all that to know when um, the dollar amount sold when that happens based on the this matrix here. When how much is purchased and when is that purchased? So you've got buy, and there could be a delay depending on how you set this up, and then your cost of goods sold, which will reduce the inventory value when things are sold. So we got all of that done. I'm going to duplicate this today for the other 9 car types because you have to do a full matrix for each one. And that's why I had to reduce this from 20 to 10, because I felt like that was still enough to make it materially useful, but small enough that I can do, these 10 matrix tabs without slowing down the model. Real quick, I wish I had an easier way to do this, but I need to tweet out that I'm live. Let's see. Let's Okay. Let's hope that works. Here we go. Um, Now once I get this matrix tab done for all 9, I'm going to duplicate this, update referencing, then I can start on adding in all this logic for the financial statements and updating everything else. So we got a lot going on this week for this one. Uh, so let's just start in here. And financial modeling, when you're building this stuff, I'm just gonna call this M2. A lot of it is figuring out how to do something to the most efficient way, and then the rest of it's spent scaling that out when you're trying to do really, really good models like this. Like this is a really great upgrade, and I think the template becomes much more valuable. I'm not raising the price. The original price is only $45 one-time fee on this, and I'm not raising the price on it. So we're just increasing value here. Now, updating the references should not actually take that long. I'm hoping about 10 minutes to do all of these, maybe 15. And as you probably know, I always do like a 10-minute overview video of all these when I'm done, so it's easier to see kind of what happened. But I'm also doing the live building of it, which is a slower process. Eight. Man, I probably could have done 10 tabs, but I feel like that was just too much. Or 20. All right, so we need to update. This is going to be monthly detail, so we just go down the line here. So 7 will now be 8. And as you can see on the monthly detail, this is We're pulling this for car type 2 now, and then we'll do that for each of these, all 10 of them. So this is just giving me the timing of how many are purchased in a given month over 60 months. Now the timing really is important for the first 12 to 24 months, and it really depends on how long each car type sits on your lot for. But it's definitely important for, especially if you're starting up or making a new big inventory strategy or purchase endeavor and here, and you want to figure out the actual cash flow and timing of that on some level. This is the only way to do it accurately and with easily, pulling levers from the top and seeing how that works on a granular level. Okay, so we update that. The age is automatically working. This is indexing, so we need to go, this was doing D. If it matches C, we now need to go to column E for car type 2. So I'll change this over to that. Oh, nope, nope, no, no, wrong one. Right here. So I get the timing of how long things are on the lot for. This one's just saying out of all the cars bought in month 1, month 2 you sell half of them, month 3 you sell half of them. And this is always offset by 1. So if you have 40% here, it means month N you buy them, month N plus 1 you sell 40, etc. So actually this is going to be, we'll just say N plus 1. But you can easily see that here too. So purchased March 2022 is a purchase month for car type 2. So you buy it in March, you're selling half in April, half in May. And you can put 0%, 0%, and have percentage over here. What do we have up to, 36 months of the time it can be on a lot for. Amount sold, this is automated logic. This is now going to go, so E5, we now want to update that to sale price. We'll go E6 now. Purchases would now be B6. And then that should do it. So that was pretty quick. So we got to do 8 more. So you see, you buy it one time for 23, you're selling for 29, and that's just based on these markups here, 30% or whatever it might be. So you have granularity to define basically 10 different car types, and it doesn't have to be just cars, it can be SUVs, trucks, whatever, smaller cars, larger cars, trucks, all that. The main thing you're varying is the cost per vehicle, the margin, start month, the amount you're buying per month, and then obviously how long they sit on the lot for. I also put in a thing for average other fee revenue as a percentage of the sale price in case there is something there that's kind of like a catch-all. All right, sold. Oh, so this was all updated. Cost of goods sold. Now here we also have to update cost of goods sold, so that should be B6. And the fun part is going to be matching all this up on the balance sheet so everything is nice and lined up. So you buy it here, sell it for this. Here's your cost of goods sold, which equals this total here, always the purchase amount. So this will be a cash flow item purchases. This will be a tax related item, cost of goods sold. All right, let's go to M3. So same thing, let's just move it down 2 now. So we're gonna go 7, 8, 9. Start in April. '26, 26. Age automated. Percentage sold. So now we go index is going to be F. And so you see that was 50-50. Now let's say it's 0, 0, and then maybe you sell 25, 25, 50. And this should always equal 100%. If it doesn't, it means you just didn't sell all of the inventory you bought. So you see here now, look, you got the offset because you're buying in April and then you're selling the first one in July and August. You sell the rest or September. Okay. It's all about referencing. Let's move this down to, what are we on? 5, 7, I think. For type 3. Yeah, row 7. 7. And the cost of goods sold. Okay, that's done. Let's keep it moving. Number 4. All right, so now we're on, what was this? 9. Well, let's make sure. So 7, 8, 9. So now we should be on 10. Yep. And you can see how if you were trying to make this logic good and it was taking a bit, you can see how cumbersome it can be to have to go back and change anything. So that's when, modeling can start to take a lot of time if you have made errors in the logic or how the math is working. But if you can get it right and then scale out the assumptions pretty quickly and accurately like this, it's a good time for the value. All right, now we're on 4, so that's down to row 8. So I should have been on G, and row 8 for 4. Let's double check. G and row 8. And it's possible I could do a find and replace instead of dragging these down and over. Like replace everything that says purchases B5 with purchases B8. But I just get worried that there's references that I'm not accounting for that might cause that to be a problem. So this guarantees, you know, that there are no errors like that. And 5, so what are we at now? 10, 11. And so this is the process of trying to make something that's going to be repeatable for many, many years in the future in a useful way. So I have to try to think about like everything has to be as automated but simple, repeatable, usable by, basically any used car lot. All right, this H, and then what are we in here for 5? That's 9. Okay. I'm curious to see how this all flows through and balances out with the balance sheet stuff. I'm get to do some accounting there. Number 6. So now we're at 11, 10, 11. This will be 12. Also, so far, I've seen really good results on the single tab or uh, 2-tab volume discount thing I did last week. So I'm really going to try to do at least one of those every week or one every 2 weeks of just like a single page calculator that has some useful logic for like any business, because that's done very well. So hopefully I can keep doing those while I'm still trying to upgrade all these startup models for the next 6 to 8 months. Shoot. All right, I'm getting lost. Getting lost. 10, 11. Oh, 12. So that's done. This percentage sold. So what are we on type 6? Column I. Okay, and then we are 10 on this. Now, once this is done, it's all going to be 3-statement modeling and updating the monthly and annual detailed cash flow, all that. And we'll solve for the minimum equity needed to keep cash above 0 based on all these assumptions. I'm also thinking there's some cool visuals we can do with this. Okay, number set. So 12, 13. Okay. J is the next column. And then what are we at now on these? All of this 10, so we're at 11 here. All right, we're moving and grooving. Number 8 is 14. We got 8, 9, and 10. What are we on now? J, K. So if you were going out tomorrow and starting a used car lot, you need to figure out how much money you're going to need, when you're going to need it, all that stuff. And this is a tool to help you figure that out with some bit of accuracy based on your purchasing plan and running expenses and everything else. All right, almost done with this part. Let's see, 14, 15. Type 9 is L. Get this over. And we got one more to do after this. What's our number? 12. Oop, type 9 is in 13. Right, this is 12. 13. Alrighty, last one. So 15, 16 here. Percentage would be M. Oh, I need some water. So we go M down, M over, dollar amounts. What's the last row? 14. Double check. Yep, it's 13, and then we want 14 here. And then we're going to aggregate all this, and away we go. I was thinking about also maybe bringing some high-level data into the assumption tabs that's just automated, like as you change that purchasing schedule. Okay, this is done. As you change this, you can kind of see what the P&L looks like for 5 years. instead of having to go over to the different tabs every time you change something. I think I might bring over some of that data at the end. I'll try not to forget. Let's put a note here. Bring level data in here. Okay. So that was the hard part, or the cumbersome part. Now let's make it make sense. So costs are now, we don't need any of this logic. Delete note. Startup costs, this would not be building, this would be more like marketing, campaign, legal fees, whatever other startup costs that are tax deductible you'd put here. Actually, we have our startup cost schedule. Let's just clear this out. This is not necessary. What we definitely do want is this purchase or cost schedule. This is no longer relevant. Now this is operating costs schedule. So it's not super, this is more of a high level thing. You can define the start month of, why is this February 2022? Oh, right. So data validation, we had to move up one. So it matched the other logic, so this is going to be a 1. And drag that down, match it up, drag it. So you can pick the start month of each cost type, what you think the cost is per month. So like here we're saying, rent is 1,700 a month in year 1, X in year 2, Y in year 3, etc. Total monthly cost per year. So say in year 1 you're doing 42,000 a month, assuming everything is active. Annual amounts that. Okay, this can stay. This is fine. Yeah, these would be things just like operational stuff. Managers, personnel, salesmen, rent, utilities. These are repair and maintenance items like on the car lot. All those types of things. So this is fine. This is great. Let's make sure we don't have any other drop-down issues. I know global control is good. Let's look at purchases. Yep, see, all this had to be updated too. So let's change this. We're going over to A1. There we go. Okay, that's good. So that drop downs works. Global control's fine. Costs are updated. Cap table has no dates. This has been updated, so that's good. Debt schedule has been updated. Terminal value needs figures. Inventory, I don't think we need this because now we have all these matrix tabs. So we might use another tab though, so I'll just clear this out for now. Startup cost is fine. All right, so let's get into it now. Where to start? Well, let's see, what do we want to do with all these matrix data? We want to pull this information. By type. So if we go over, we'll start with the monthly detail. So purchase per month, this stays the same. Making sure that's still the right VLOOKUP. So it'd be doing C, F, and then G to K. So C to F. Yep. C to K. And we're just matching the year and the car type. Okay, that's good. So this is fine. We got this going. Sales by car type. So here, we're going to go, oh, undo. We're going to have to dynamically pull this. So M1 through M10. And this will make it much quicker for me is using an indirect. And so what I want to do is month one, we'll do indirect M1, and then let me see for per total dollar sales. We want B252. No, shoot, indirect can't slide the reference cell. That's fine. So what I can do is just, we'll reference this, lock the row, and we just simply go 1, 2, 3, 4, 5, and this will be easier on the next one because I can just copy this down and then just replace the row number. We don't need this. So here's my actual sales revenues coming in. We've already counted for all the offsets, timing on the lot, all that stuff. So all that's going to scale these numbers based on the purchase schedule. So we got sales, cost of goods sold. So we do look at this, very simple. Copy, watch this, paste, and then we just pull the cost of goods sales row instead. So instead of pulling 252, we're going to pull 376. So I just go replace 252 with 376. Replace those 10. And there is cost of goods sold lined up with one thing sell. Now remember, this is a non-cash flow item. This is just trying to represent our purchases, but it's a non-cash flow. Our purchases are where this cash actually initially goes out from. But, you want to calculate margins and gross, like you have to match this up to actually have a proper model. So that's why it needs to be here. All right, so total cost of goods sold is fine. This is great. Monthly cost work, looks like that's fine. Yep. Oh, I did an index match here. That'll work. That will work. EBITDA is just gross profit less. Now we got to add in other revenue. Let's see. let's put this in 33 to 5. So 31, 37. What we want to do is show uh, other fee revenues. And let's see the easiest way we can calculate this. So if I go, here's the percentage. So I could do a sum product, I believe. And it's just going to multiply each of these percentages in the same order relative to the dollar sales of each. So it'll take this times that car type 1 percentage, that times this, plus that times this, plus that, etc. Which is great. Then we just lock our column, and there's our total fee revenue. In theory, so this should just be, I think, 2% because it's all 2%. Yeah, good. Okay, so that's working. So we've got other revenues, and then total revenue. We can just put a bottom border on this. And this get a top and double bottom. Bold. Oh, car sales revenue. Also, no, that's fine. Okay. Total revenue is just adding these together. Bold them up. Let's drag all this down. So there we go. Total revenue. Now when we go to gross profit, we actually want to pull the total revenue number. Okay, and then EBITDA. Yep, that's right. So you can see here you've got a negative value because we've actually we've got no sales yet, but we have some burn with some of these and these are arbitrary. Obviously, you go in here and put in your own costs and timetables and everything, but you can see just what the kind of strategies you can do with the timing of when you start selling cars, how long that takes, and when different things sell. And then what's your OPEX look like? This is all very important for the first, 12 to 24, 36 months of operations so you can stabilize. So here's EBITDA, debt service. Let's see. How do we want to do this? Debt balance. Do we care about debt balance? Not really. You can always just go to the debt schedule and see this here. I just want to make sure I get the amounts. These are doing VLOOKUP. I guess that works. No. Yeah, that'll work even with the update. Let me roll over. Yeah, that works. Okay. Debt service covers just the operational income against the total debt service. Now, now we have to get the actual cash flow number. We have to do inventory purchases. And here, we need some more spaces. So inventory purchases for each car type. Total inventory purchases. So we'll make this a granular calculation as well. And what we want to do is same thing here. Same thing as cost of goods sold. Copy this down, paste it, some. This is going to be, where's purchases? 314. So we just do a find and replace here. Replace 376 with 314, I believe. Right, 314. Yeah. So this would increase inventory, while cost of goods sold decreases inventory. So here's our actual purchases. So when we go to calculate cash flow, and there's going to be more aspects to this, but this is the most complicated part. We don't even need this cash flow after debt. So debt service, inventory purchases. We'll keep this formatting. These are all items that affect cash flow, startup costs as well. And this is just on a new tab. Okay, we don't need all this leverage on leverage stuff. That's not important, not important. None of this is important. Clear this out, and we just want to show cash flow. And that's going to equal our EBITDA plus add back cost of goods sold minus debt service minus inventory purchases minus startup costs. So we've made a clear distinction that we're separating startup costs and inventory car purchases because they need to be. We'll give this a top and bottom, thick bottom. And that's our main cash flow, and then we can put cumulative cash flow, and this will be an important number to figure out the minimum amount of cash we need based on all of our assumptions. Other things, so let's drag this down more. So we've got startup costs, inventory, debt service. We also want to put in here, and these aren't done yet, but we'll have to put in here taxes, sale of fixed assets, if applicable, sale of business, if applicable, and then this could be a different thing because we kind of want to say, well, the value of the business is probably equal to some multiple of EBITDA, which is just kind of saying how much operational cash flows are we creating here. So multiple of EBITDA, and I'm wondering if we also add in like ending car inventory. Probably, because that's the only real relevant asset that like has value besides the fixed assets that are separate. So we'll probably add that in. I think that makes sense. Um, so subtract all of these, or subtract taxes. Add this, and then minus this. We're also going to put in here CapEx of other stuff. And again, that will be more related to the CapEx schedule that we have not done yet. So you can see this initial burn happens while you're still building your sales. You're taking a while. You're buying inventory and it's taking, a couple months to sell it. And eventually you get to a positive cash flow is the idea. And then possibly exit or just keep operating. However you want to do it after 5 years is adjustable or configurable. So, let's get into, so that was really good. Um, let's just make this congruent. So monthly is fine. Uh, the annual annual detail we're going to have to update to match everything we just did. Honestly, it might be easier just to delete this and just make a copy of this at this point. Oh, shoot. Annual detail. 1, 2, 3, 4, 5. Got our year in here. Annual. We don't need this or this. And then all this is just going to be some ifs. If the year matches. Okay, and then we lock here. And there. So I should be able to drag all this up and down. Match up that. This. That's the same as the percentage. So this gives you a nice 5-year view of all these different metrics. That's the same. And then we'll put all of these in, even though they're not calculated yet. All right. The other thing, see, I already forgot something, is debt proceeds. Just want to make sure it's not somewhere I'm missing. I don't think so. Debt proceeds is another big factor. So this is going to say if this and it's offset by 1 month equals this month, then pull this total, otherwise 0. And so that's the number we look at before we figure out how much equity is required. Okay, and then the annual, we just simply go equals this, and then if it's not there, it'll just be calculated in the sum ifs like this. And we'll add that in as well. All right, so we should be matched up. Let's check. So this minus the monthly should always be 0. Good. So we've got all good mapping. All right. So what we're going to do now is we've got monthly detail, annual detail pretty good. Let's start in with, now I believe we can start it on this income statement. So here we'll have revenue, car sales, and fee revenue, or fees. Car sales is going to be right here, monthly amount, total car sale revenue, and then fees is this. Pretty simple. Cost of goods sold, definitely relevant. This is going to be only inventory. Let's see how we do this. So this is inventory, cost of goods sold. I don't know how this may work exactly. And we're just going to have to see when we get here. Let's look over here. I just want to see. Okay, yeah, these margins are lower. Let's say you're marking them up. So if you mark it up double, you're making a 50% margin. Sell it for 10, cost 5. Probably should put profit margin here. Probably should have that. So this minus this, which will just be a function of your markup. So here, if we marked it up, 200%, your margin is 67. If you marked it up, say only 25%, your margin is 20. You marked them up 35%. There you go. So let's just put it all at 100. So you're doubling them all, making a 50% margin. Just for the sake of this, these will all be different compared or depending on your market and what cars or vehicle types you have. I'm gonna change this to vehicle type. It's like the margin builder. Configure it. Actually, we'll put vehicle metric configuration or vehicle assumption configuration. Vehicles purchased per month. Okay. The schedule defines how long vehicles sit on the lot for. relative to when they were purchased. Okay, that's even better. Awesome. All right. Yep, there's that. Those margins look more normal. So we have cost of goods sold, inventory, gross profit, OpEx. So here, um, we don't have a whole bunch of costs. I mean, 20 items, I could probably fit that in here. So there's four. Well, do we really want to? We can just put, uh, operating costs, startup costs, and we don't need these. So startup costs is this number. OpEx is going to be monthly detail right here. This goes over. This is nothing. Perfect. Okay, we're getting there. OpEx, EBITDA, interest. That's good. Does interest here have that logic to stop if it's an end month? No, it doesn't. Let's put that in there. So if our month greater than the exit month, then 0. And we definitely want to put that in front of here too. Okay. Instructions, we don't need this. We're gonna do an overview video for the instructions. So if my end month was, oh, we gotta put a drop down in here. If my end month were November 2026, I should see the interest stopping. Also on our monthly detail. Yeah, interest stop, payback, okay. We gotta update this. Same logic, these costs should stop if we're at the exit. Ah, shoot. Undo, undo. So what was wrong there? If E4. So this got to be locked and that's got to be locked. Oh, let me make sure those are not changing. Okay, good. Zero that out. Now this part could get tricky with the inventory stuff. Let's try to zero out the top row here. Oh, shoot. And I'm going to have to do this for each one individually. Sorry for the noise. Oh, wait. No. No, I don't. Hold on. I can drag these, I believe. Yeah. Okay, so 0. Now these I can't drag. So we're just trying to say stop activity on or after the month of exit. Yeah, I'm thinking about it. We're probably gonna have to do something with the inventory on the end month if there is an exit value or terminal value that you want to include. If you select yes on that input on the global assumptions, then we're gonna have to do logic on the balance sheet to account for all that. Okay, are we good now? I believe we are. Let's get back to the income statement. So that was, yep, okay, so good, all zeroed out. Depreciation builder. So this should be linked into our CapEx schedule and just be fine. Yeah, this is good. Our terminal value, we'll have to work on that, but for now, I think all this logic is fine. Terminal value, yeah, we'll have to go into that. And taxes, I believe is fine. Trailing 12 months. Okay, we're cooking here. The question is, do I want to mess around with the terminal value stuff today? I'll make sure this is 3031. So the trailing 12 months EBITDA is how we're going to do this. So trailing 12 months EBITDA for the valuation. Okay, terminal value. No, otherwise sum, and we want row 28. Okay, and multiple there, it'd probably be like 3. There'll be lots of rules of thumb on that. It definitely would be worth looking that up if you're actually trying to sell something. So valuation is 19 million. You just put 100% on this. You got your building based on this capex here. That's valued separately, and then you've got the business value and anything applied to capex from this. Okay, so this is all good. The question is, do we also add ending car inventory to this? I believe there should be some multiple of that. Like if you have, uh, you know, 1.5 million worth of inventory, that's going to be added into the sale price for sure, and maybe on some multiple above the cost basis. So I believe we're going to add that. So let's put it in here. We're going to add that in. Now I see we're doing taxes. This would essentially be income taxes from the perspective of the business as in itself before any cash is distributed. And taxes can get really tricky. That's why I mean you can just zero them out if you don't want them in there. But I mean if you do and want to see that cash flow effect, especially if you're a single operator with no and not joint venture or any investor money, you probably want to see taxes. So I wanted to keep it in there as an option. So let's think about this. The annual looks good. That's fine. And then this matches 59. So our income statement monthly and annual is good. The real tricky thing is going to come into, yeah. So inventory, let's see, how do we want to do this? Let's go to the cash flow statement. Actually, I kind of want to save this for tomorrow because this is going to be kind of cool, and I don't want to do it at the end of the stream, especially because I'm already kind of getting to the time I want to be done. So tomorrow we will do cash flow statement, balance sheet, and start our sanity checks. Make sure the executive summaries, we'll have to update that. Distributions will be updated, and then we should be getting close to done. So tomorrow we'll be done. Then maybe Thursday, Friday, do another financial calculator of some sort. So going good here. Keep it going. Definitely huge. This used car dealership, used car lot model is it got a lot better with this upgrade. A lot better. Um, so I'll see you guys tomorrow on it, and